So just in terms of the highlights, this is our second full year of reporting, and once again we've delivered above what we said we would deliver to the market in terms of our guidance. We delivered 14.02 cents per security, and we've continued to grow our portfolio, which I'll speak very briefly about in terms of what we've been doing. We've replenished our pipeline, so we completed acquisitions in 2018, but we have a strong growth pipeline. We'll talk very briefly about capital management. We've done a lot of work in terms of our balance sheet, both on the debt and equity side now, obviously with our capital raising. And our distributable earnings guidance growth is 3 to 3.75% growth over 2018, which is the same guidance that we provided over 17, and we've raised capital as well. In terms of our results on the financial side, our earnings were up 4.5% over 2017. That's 14.02 cents per security. Our NTA is $2.20 per security. That's up 3.8% from the previous year. And our management expense ratio is at 20 basis points, which we certainly believe, sadly to our own personal detriment, is one of the lowest, certainly in our sector. In terms of acquisitions, our portfolio has grown and is now at $2.5 billion. You may recall at the time of the IPO, we were $2.1 billion of assets, and we've increased our number of assets from 425 at IPO to 454 at the close of the year last year. We still have a very long WALE, so the average is 12.6 years. As you'd be aware, the majority of our leases are triple net and 95% of our income comes through from Viva Energy leases, and they have the fixed 3% rental increases. Our portfolio remains split 3/4, 1/4 metro versus regional, and we're very happy with that mix. In terms of capital management, our gearing ratio at the end of last year stood at 36.2%, and on a pro forma adjusted basis now, after the raising, it's back to 32.3%. Our weighted debt maturity is just under 4 years, and that increased from 2.5 years, effectively 12 months previous. As I mentioned, we've increased our debt facilities, both in number and in volume. We've lengthened our debt tenor, and we've also diversified the sources of our debt. So we've done quite a bit in terms of capital management. I'll just get Guy to briefly touch on the financials. I did want to mention, as Will said, the SPP. So the SPP documentation will be out this week. That SPP is effectively at the $2.32 price, which is the same price as the placement, and we closed yesterday at $2.42.
So I'm going to run through the statutory profit and then how we calculate distributions. So we distribute cash, but obviously we calculate the profit in accordance with the accounting standards. So if you take a look down that left-hand column, full year to 31 Dec 18, you'll see rental income's up. That's largely due to those guaranteed 3% fixed increases that Margaret mentioned, plus acquisitions over the period. There is some nuance around leases that have fixed escalations. You're required to recognise a bit of the revenue early, but we back that out for the purposes of distributions. And the property portfolio increased in value by a net $43.6 million, and Margaret will walk through that with you. It was a gross $77 million. We run the business very cheaply, as Margaret mentioned, and pay a tiny bit of tax, which is a one-off, leading to a statutory profit of $167.1 million. So how do we calculate what we distribute? So taking that $167.1 million, we add back our debt establishment costs, we add back the accounting, non-cash accounting, straight lining, we add back the non-cash property revaluations to get to a distributable earnings of 14.02 cents per security, and that was 4.5% better than it was in the previous year, and beat our guidance, which was from 3 to 3.75%. An obvious question is why isn't there a lot of capital expenditure like there is in most REITs? Why isn't there an incentives? Why isn't there non-recoverable repairs and maintenance? And that's because of the triple net lease structures, where virtually every property we own, all of the costs of ownership, capital expenditure, repairs and maintenance, all that sort of stuff is paid by the tenant. So the security holders have very, very little exposure to any capital costs, non-recoverable repairs and maintenance, no incentives, that sort of thing. Moving on to, I think, the capital management slide, the key sort of issues here from the REIT's perspective is we are a 100% payout ratio company of our cash profit, and we can do that because of the structural advantages we've got that I just mentioned. So how the balance sheet's constructed is really important. We spent a lot of time this year pushing out our debt facilities to get some longer tenor, increasing those debt facilities so we can take advantage of opportunities as they arrive, and as I mentioned, injecting some more equity into the balance sheet to reduce that gearing further so we can make sure that we've got a good runway for growth for the next few years. Cost of debt is self-evidently very important, and we are 94% hedged on the drawn debt for 3.9 years, and you can see that remarking to market in the swaps happens very gradually over the next few years. And one thing that we can say is that curve we continue to work on to make sure that as interest rates change, the impact on the REIT is moderated. I'll hand back to Margaret. Thank you.
Thanks. I was just going to very briefly touch on the portfolio. There's a lot of detail in our presentation in terms of the acquisitions that we made, but we did make $124 million of acquisitions. That was at a capitalisation rate of 6.4%. So we do have a strong pipeline for 2019. As part of the capital raising, we did say, and we've publicly stated, that we are looking at a pipeline of up to $130 million of acquisitions, and we currently have 67 million of those in advanced due diligence. So, you can take a fair degree of comfort from those numbers.